So for a 250 student school, let's say it was like, you know, 3.5 million. So call it 3 to 4 million top line.
Target approximate size revenue, 3.5 million of revenue, about 200 students paying kind of 12 to 14 thousand dollars each. EBITDA, so that means you're not paying rent or you're not factoring in the cost of rent, was somewhere between 500 to 800 thousand dollars. Buying them for around 5 times, so 2.5 million for the value, and then upstream, once you get this whole package, maybe you're above 40 or 100 schools, and the multiple is 12 to 14 times. So maybe you could get double or triple what you paid for an individual school. So Esteban, you've had a really cool career. You've started a number of companies. It looks like you've exited at least two businesses to public companies, and now you spend most of your time as a VC investor and private equity investor. For today, my audience loves to talk about deals. They love to learn about investing in businesses. So I want to spend most of our time talking about that. And I guess maybe to just kick us off, can you tell me a little bit about how you went from being an entrepreneur, an operator, to becoming an investor? What was that transition like for you?
Yeah, it's awesome to be here. Thank you for having me. I was one of those kids, that was always like disassembling stuff at home and parents getting upset. I was the youngest licensed radio operator in Colombia, as far as I know. I tend to be extremely action oriented, and my grandfather was kind of the same way. 8 years old, maybe nine, I was in his office. I used to go to the office like every Saturday. I was checking out his desk and opening his cabinets. He would get very upset at it, but I would still do it. And then I found a gun. It was his gun. And I knew that I wasn't supposed to play with it, but I went and asked him. He said, "Hey, can you tell me, how this works?" And that's the first time I realized that, hey, it's not only great to be an entrepreneur, employ other people, create value for customers and grow your company, but actually you can sell your company and be successful with it. Um, so that informed what I would hope to do for the rest of my life, which was spending time building companies, helping other build companies. And then at some point, I realized that while I was at the acquiring company, I realized that I wanted to go back to starting, my next venture. So I did the earnout, and then I realized that it was the time. I wasn't sure about what idea to go work on next, but I was hanging out with a bunch of entrepreneur friends, and I was listening to their ideas, and they got me really excited. So I ended up becoming an investor without knowing. They were like, "Hey, I want to start this business. I'm probably going to have to raise some money." And then if I was really excited, I would, tell them, "Hey, don't raise money. I'll give you the money and I'll work with you very closely for the next 6 to 12 months." So I didn't really think of myself as an investor. I still, foolishly thought that I was an entrepreneur, but I
Mhm.
was playing the role more of like a founding investor. So ended up helping start a few companies that way. And some of them, they were buy and build strategies, which we'll talk about today, or roll up strategies. And yeah, that led me to three other exits. And I guess that's how I transitioned to what I do now. I run a fund called Zenda Capital, where we invest in early stage tech companies, primarily vertical software and vertical AI. So the way we think about it is we want to back founders as early as possible that are bringing modern technology to old industries. Um, and then in parallel, and this is more at a personal level, I spend a lot of time with private equity plays, usually buy and build strategies. Oftentimes, I'll start a company from scratch.
Now, how do you think about something like risk sizing between the two opportunities? If you're doing a private equity type investment versus a VC investment, do you have a check size range that you prefer to do, or a number of investments per year in each category?
Yeah. So for the VC investments, usually we're writing checks anywhere from 500,000 up to 1.5 million. Um, leading and co-leading rounds most of the time, participating sometimes, and we're looking to build a portfolio of about 20 companies. So it's still fairly concentrated for the stages that we invest in, which are predominantly seed and pre-seed. Um, but that's kind of how we think about it, and we look to make 4 to 6 investments in a year. So our investment period is truly 3 to 4 years. We think that is the best way for us to deploy capital. We don't like to write a lot of checks, and we like to spend a lot of time with the founders that we're backing, probably even before they've started the company. So that requires just a much slower, higher conviction pace. And then for private equity, I mean, that's mostly personal capital in the things that I get involved in. So it is more opportunistic, and it tends to be 1 or 2 deals every few years, right? But I tend to go very big on those, and usually starts with a smaller position, anywhere from $500,000 to $1 million, and then it just scales from there, to several million over the um, life of the project, let's say.
Okay. That's helpful to hear. What was the first roll up that you got really involved in? Is it this Thirdera business, or was it another company?
No, it's a company called Endeavor Schools, which was led by Ricardo Campo, co-founder and CEO, amazing guy. And basically, how I came about it was after I sold my first company called Verification Bureau, the fraud prevention company I talked about. The bankers who advised us in that transaction, they became friends, um, and they were exploring opportunities within the education space. I had always been very intrigued about a company called Alt School that was trying to transform early education through technology. But I was very concerned about how long that feedback loop would take, right? Because asking parents to trust you with their kids' education and let's see how it works out, and see if they can get into any colleges and so on was just a very big leap of faith. So these bankers came and pitched an idea of consolidating the private early education space, which I had already been sort of dabbling into. And then I met Rick Campo, and that sort of converged. So I got involved with that with some others as the founding investors. I was part of the board all the way from the early phase of the company through our exit to Leeds Private Equity, which was the first exit. We kind of retained ownership in that business and then sold later on again. But yeah, that's the first roll up strategy that I got involved in. Initially, we acquired 4 schools, and these were primarily, yeah, I guess there were schools from ranging from like 200 to 250 students. Um, and we were trying to understand a little bit better like what was the profile of the acquisition target, although we had some general framework that we had defined early on around demographics within the metro areas, profitability of the schools, longevity of the schools, um, enrollment metrics, and so on. But those 4 were kind of like a learning ground where we actually went from, okay, here's a hypothesis to how do you actually operate these schools and what does it mean to own private schools. And then we ended up scaling that to about 37 schools acquired and a few more under LOI at the time we sold to Leeds. So yeah, that's kind of like the high level, but I'm happy to go into more details in that one.
Yeah, I'm always curious when you go into a new industry that you don't know super well and you're kind of figuring out the thesis. Maybe you bought 1 or 2 or 3 of these businesses. What are some of those things that you learned? What are some things that didn't work out for you guys? Right? Okay, we bought this. This was not a good idea because of X, Y, Z, and we bought this, and this was a good idea. Whereas we bought another one, and this was a good idea because of ABC. Can you talk a little bit about what some of those early day learnings were?
Yeah, so the worst idea was like buying schools that had some flags early on and that we thought that we could fix. And what I mean is like just fundamental things that maybe were stretching our investment criteria a little bit, and that didn't end up playing out. So the learning there was like, I mean, I'm not saying it's impossible, but it's rare where you know something that the previous owner doesn't know about how to fix their business, and you pretend like you can walk in and you know fix the business successfully. The other part is initially when we acquired some of these schools, we're like, okay, here's 100 things that we can fix theoretically, and we could probably fix them, right? Or maybe not 100, but like a number of them. But it really came down to like one or two that really mattered. In the case of Endeavor Schools, it was enrollment. So usually the educators that had founded and operated the schools were amazing at educating, not necessarily amazing at operating. So what that meant was that their marketing was subpar, their enrollment experience and process wasn't really tight. They weren't really managing it as a sales process, let's say, um, and that led to just not great conversions, maybe not enough leads to improve enrollment. And enrollment is a great driver of profitability because your fixed costs are essentially the same. If you have 10 more students, it doesn't necessarily mean that you're going to need 10 more teachers. There's a ratio, and it almost all of it goes to the bottom line. So we realized that early on, and that became an area of focus, and that was probably the one thing that we understood that we could use as a lever, and if we were gonna create value, that was the thing to focus on.
Yeah, that's a great insight. I mean, when you go into some of these small businesses, there's a million different things that you could be doing better, and it feels like a thousand different things that aren't going well. And I think the default is, okay, we should fix all of these. Like, let's attack them all head on and make the business go from down here to up here. But it's also been my observation that if you buy right, usually there's just one or two levers that really matter. Hopefully, right? You can isolate to those variables. So, did you start looking and kind of processing deals that you felt were under under enrolled, meaning like maybe they're 90% enrolled, they could be 95% enrolled. Did that become a key criteria of yours?
Yes, that was part of the key criteria, and we factored you know that into our upside, and we were able to sometimes negotiate deals that others weren't able to, just as a result of that. And that wasn't the only thing, obviously. I mean, we prioritized things like um, understanding the operational history of the school, understanding how it was perceived within the community, the quality of the education, and so on, which kind of led us to another insight. And it was that if we were buying schools that had very different educational models, it was hard to um, find ways or find synergies, let's say. And we ended up indexing within the Montessori school model, and that made a lot of the underwriting and a lot of the value add initiatives easier.
Got it. Yeah, that's a really interesting insight. So Montessori schools, any particular age or K through 12 throughout?
Initially, the thesis was K through 12, but we ended up focusing more on early education. Um, and yeah, the majority of the portfolio at the time we sold was early education.
What were some red flags that you could pick up on during diligence that would lead you to say, okay, maybe this is not the right opportunity, right? You found a Montessori school, it's of the size that you want, maybe in the market that you want. What are a couple things that would jump out at you to say, okay, this probably isn't the best opportunity for us?
Reputation of the school, is a one that was very, very important. So as part of diligence, understanding how the school was perceived by the community was critical. Also, talent quality, meaning like the teachers' quality and the longevity of how, or their tenure, how long they have been at the school. Seller motivation, like for example, a lot of times deals were structured where there was a cash component and there was an earnout or a seller's note, and that was by design. We wanted to make sure that the seller was motivated to stay around and um, support a transition, or even better, which was actually the preferred mode, um, keep running the school, right? Like from an educational standpoint, we would take over the operational aspects. Um, yeah, so like if I guess just to make that more concrete, if there was someone that just wanted to get paid and walk into the sunset and not have anything to do with the school, it wasn't always a no, but it was a flag and something to understand. Yeah, so those were like some of the things. Um, Trying to think if there was anything. Yeah, like financial history. So like, schools tend to be pretty consistent, and they're not growing super fast for the reasons I mentioned before. Maybe student acquisition and enrollment is the biggest challenge that a lot of these operators have, but they still just organically grow by word of mouth, especially if um the quality of the education and the experience for students and parents is good.
Mhm.
So if you kind of historically saw some ebbs and flows, those would get our attention, and we would want to understand what caused them, um, and we would want to make sure that it wasn't like reputational issues or things like
How
that.
do you find out the reputation of a school? Do you just talk to parents or look at Google reviews? What's kind of the method there?
Yeah, I mean, yeah, there's obviously a lot of public information these days that you can go find. Then also talk to parents, talk to teachers, talk to former teachers.
Former teachers. That's where all the secrets come out. Former
Yep.
parents of former teachers.
Exactly.
That's
Yep.
where you can learn a lot, I think. Um, so you buy 20 plus of these schools. Do you, when you come in, do you change the name to Endeavor, or do you keep the local school name and you say powered by Endeavor? Does anybody even think about Endeavor? Like, where does Endeavor fit into the picture?
No, if you think about like a 200 to 300 student school, and you know, a lot of them in suburbs, some of them in metro areas, they tend to be like um, community hallmarks, and we wanted to keep them that way. We didn't want parents to think that because there was an ownership transition, it was now like going to become more of a corporate entity, and things were going to change as far as the experience and education quality um, for the students. And same thing with the teachers. So we found that it was um, way better just to leave everything about the brand, the legacy of the former owners untouched, and just kind of operate in the background as Endeavor, which was the company that was helping things become better, but not necessarily trying to change things from the parents' perspective and the teacher's perspective.
I think sometimes in the world and in the media, private equity gets a bad reputation. Private equity comes in; they're the big bad guy. They come buy a business, and maybe things start to fall apart. Um, did you guys track? And of course, that's not always the case, right? Plenty of good things are happening with private equity. Did you guys track kind of success metrics, students' success, teacher happiness, or anything like that from before you acquire a school to after you acquire a school? I'm curious how these schools and communities transformed once Endeavor got involved.
Yeah, I mean, we definitely track that. We used NPS as a metric, and this was for teachers, and I think for students it was slightly different. Um, yeah, I mean, it was important, and I think this was Ricardo and the operations team, and the executive team that did all this work. But it was very clear. that there was a difference between being an independently owned school, um, to being a Endeavor owned school, not just because we were giving the local schools or the individual schools better resources and the teachers better resources. We had some economies of scale, we had just a bigger platform, but also at the corporate level, we were able to consolidate a number of functions that allowed the schools to operate more efficiently and therefore, be able to just offer a better experience to students by reinvesting in certain areas that otherwise they could have not been able to invest. Specifically, we consolidated finance, um, HR, marketing, and then we consolidated to some extent the IT functions, although because these are brick and mortar locations, they needed local IT. So there was a big difference, and um, how it translated was basically just being able to invest more money in the individual schools, whereas as independent schools, with a principal owner that is more focused about the education, rightfully so, it's just hard to manage so many things at the same time and find
Yeah,
efficiencies.
I bet. And let's talk a little bit about the economics of these deals. So when you're buying a single school, how much revenue are these businesses usually doing? What's their EBITDA profile look like? And what multiple range at least are you looking to pay?
Yeah. So on average, the annual enrollment for these schools was like 14,000, between 12 to 14,000. So for a 250 student school, let's say it was like, you know, 3.5 million. So call it 3 to 4 million top line. EBITDA. Oh, I missed an important detail, and is a lot of times we would acquire the operating entity as well as a real estate asset, because oftentimes the owners would buy the real estate, right? And so we would separate those. So putting the real estate aside, I'm talking just about the operating side. The EBITDA, which means EBITDA excluding or also excluding rent, it was in the 15 to 20% range. And this is pre corporate overhead. In some cases, we would find schools that were operating at 25%, but these were usually schools with higher enrollment rates and maybe in slightly more affluent areas where they were able to charge a little bit more. Um, and Going in, and this evolved throughout the, I guess, journey, but going in, we were underwriting schools anywhere from 4 to 6 times EBITDA at that scale. And we were looking at, a number of companies, including publicly traded companies that were trading anywhere from 10 to 14 times EBITDA. So the base case was, hey, we're going to buy these schools, improve them within their forward walls from a, you know, financial perspective, operational perspective, and also student and parent experience perspective. And then we'll integrate them to the platform, which obviously gives another layer of efficiency and scale, where we will become an attractive target for acquisition once we reach at least 30 to 40 schools. So that was the, I guess, individual deal underwriting as well as the higher level thesis.
Was there a specific company that you would look to downstream from you guys that was either bigger or public that you would pattern match on your operations or finances and say, okay, these guys are a real inspiration for what we're doing?
Yeah, Bright Horizons was one that we tracked. Then there's others like Laureate Education, um, and there's a few more, but those are like some that we tracked and that are publicly traded. Bright Horizons, for those who don't know, is U.S. based company, about 7 billion market cap as it is right now, and then Laureate is also U.S. based and roughly 3 billion. So yeah, at the time, those were kind of like the metrics that they were trading at. 12 to 14 times, and that became a north star for us from just like understanding what the upside could be. There was also kinder care learning. Now it comes to
Mm.
mind. Yeah, so there's quite a few. Most of these are operating the schools. They didn't own the real estate, which is something that we realized later on, and we ended up doing a lease back of the real estate and just getting liquidity from those
Okay,
assets.
so you guys sold the real estate to some private equity firm as a bundle, maybe signed like a 15-20 year plus lease with them. And then you could just focus on the operating business, which was running the schools.
Yep,
Um, so
precisely.
just breaking down the economics, just so I walk through it for folks listening. Target approximate size revenue, 3.5 million of revenue, about 200 students paying kind of 12 to $14,000 each. EBITDA, so that means you're not paying rent or you're not factoring in the cost of rent, was somewhere between 500 to $800,000 per school. Um, and then the multiple paid is somewhere between 4 to 6 times. So say on the median, maybe you're paying around $2.5 million per school, and maybe there's a little bit of structure there. Maybe the owner is holding a bit of a seller note. Maybe there's a bit of an earnout. Did you guys end up getting a? Oh, and I guess to finish that thought, um, you're buying them for around 5 times, so 2.5 million for the value, and then upstream, once you get this whole package, maybe you're above 40 or 100 schools, then each then the multiple is 12 to 14 times. So maybe you could get double or triple what you paid for an individual school at that higher level, at a much bigger size. So that's kind of where you're heading. You start by buying smaller businesses with lower multiples, and as you stack them together and you get the synergies and you get the brand, you can create a lot of value, a lot of equity value upstream through that multiple arbitrage. um, I'm curious, what was the, if you're a private equity firm like Leeds, or even if you're a public market, why do you think they ascribe a much higher multiple to the businesses than when there's like one or three schools packaged together? How does it go? Can you explain to listeners, how does it go from 5 to 6 times EBITDA to maybe 12 to 15 times EBITDA?
Yeah. So there's just a lot of work to be done in buying these individual schools and aggregating them and integrating them so they can operate as a platform. So, for example, we acquired these schools across the U.S. Although we later on developed some regional clusters, we needed to uh, hire and manage regional managers that oversaw these individual schools. We needed to make sure that we were achieving certain objectives at an individual school level, as well as a regional level, as well as at a corporate level. So these are things that you just don't have if you're an independent school, or even like if you have two to three schools, you don't have any of these things. Um, and the as I mentioned earlier, the level of efficiency that you can achieve as you're scaling your platform um, is what also becomes attractive to a lot of private equity firms. They're looking to deploy bigger dollars. So for them to go and buy these small schools, as they would say, the juice is not worth the squeeze, because it's going to take them the same time to buy, $3 to $5 million school than to buy $100 or $200 million platform. The diligence is, pretty similar. Maybe there are some differences on the margin, but the effort is kind of the same. And then they're buying a platform that already has an executive team in place that has a vision for how to scale the business, which is not something that you're going to get if you're buying, an individual school, or even just like a smaller regional group of schools. So that is the reason why. The way that a lot of private equity firms would look at it is, um, if they can scale the platform, and the market is it still has that upside, which in the early education market, it's highly fragmented, still is very fragmented. um, then they're able to deploy more dollars. They're able to sort of blend down the entry multiple that they're paying, which is relatively high to individual assets, if they can keep buying more assets, right? Like over time, more individual assets. So let's say they pay, let's just pick a number, 10 times EBITDA for a platform like company, and then they go buy more individual schools at 4 to 6 times EBITDA. So, when they've deployed 2 or 3 times the capital they paid for the initial platform, they would have blended that down significantly. And that's how they create their own value. And then, they may have ideas around taking the company public, and then at that point, you're sort of trading um, to comps like the ones I mentioned earlier, or selling to an even bigger um, private equity firm that has a similar vision, just at a bigger scale. So yeah, that's kind of in general what I've seen, and that's what played out with Endeavor Schools.
Awesome. Yeah, I think that's really insightful. And I guess one more question on Endeavor. How did you guys finance it? I assume that at some point of scale, when you get to 5 or 10 million of EBITDA, you can get a credit facility or you can get some sort of like debt line to buy new schools. Is that what you guys did? You guys started with equity and built up to a certain scale and then were able to refinance some of it?
Yeah, the initial deals were pretty much all equity, especially for the operations that we were acquiring. The real estate, we could get some level of financing with local
Hmm.
banks or community banks. But yeah, once we achieved a certain scale, we became attractive for cash flow lenders. So we were getting, a few EBITDA turns in debt, which obviously would make the economics more attractive. This was also done at a time where cost of capital was very, very low. I mean, we're talking, you know 2013 through like 2018 or 19. um, so timing was great from that perspective, and we could get a positive arbitrage on the debt. Yeah, but it was done in the typical way that a private equity firm would finance acquisitions, by leveraging a cash flow lender.
Okay, awesome. I want to switch gears. When we were talking before this interview, um, we discussed some of the things that you're excited about, and one of them is roll-ups and how you can apply AI to different industries to improve the businesses, to increase profitability. And actually, I think today in the Wall Street Journal there was a big article about this idea how venture capital is going big into roll-ups, investing in these previously private equity focused businesses with the lens of efficiency creation through artificial intelligence. And there's a couple of companies they named, like Long Lake Management Holdings, Crete Professionals Alliance, Crescendo. I'd love to hear a little bit from you. What kind of gets you excited about this industry or this new area, and how do you think about it?
Yeah, one of the things that I've noticed in the venture capital side of the house, let's say, or the investments that we're making there, is this continued trend of founders building companies where they're using AI to replace a lot of labor. And, like for example, we invested in a company called Gaia Dynamics that uses AI to replace trade compliance experts. Historically, if you're looking to import stuff into the U.S., you need to comply with a lot of regulations, and those seem to be getting more complex. So historically, you would need to go and hire some consultants or lawyers that understand um, what all these trade compliance regulations are,
Hmm.
to make sure you're not violating anything. So um, now you can do that with AI by analyzing a lot of the requirements, and um, you know making a process that would have been weeks or days to seconds. So, for example, one idea that we've been excited about is there a play where you can go and acquire a number of customs brokerages, which are requiring these services or providing these services sometimes to others, and take out a lot of the labor requirement by using technologies like Gaia or even proprietary technologies, and use that as an additional lever for creating value. And I think where it becomes interesting for us is kind of having a purview into both sides. Having had the roll up experience and then also making investments early stage. So we're spending time trying to understand how to coalesce both, and maybe where the next roll up opportunity is one where we are um, leveraging AI as like a main driver. Another area that is really interesting is RIAs. There's a lot of work and analysis that is done manually by these IRAs. There's platforms that have been built and that are used by firms like Adapar and so on. But if you've seen Adapar, I mean, it's a great product to manage the workflow and the reporting side, but it doesn't really leverage AI in a way that we think could be done. So these are like some examples, but the essence of it is um, wherever you have a human in the loop that is spending a lot of time with tedious work like analyzing data, and then reporting on the data in order to make a decision. That is like a perfect use case for AI to play in. And if you apply it really well, then that could be a way for taking what historically would have been a 20% EBITDA business to maybe 30-40% EBITDA business. Um, and it's our belief that even though AI is becoming more and more commoditized and accessible and digestible for a lot of people, if you're applying in the way that I'm describing, it still requires domain knowledge and certain expertise that not everybody has. So we think there's an opportunity there to kind of marry uh, uh, all of these ideas and create value. And we're very actively exploring those and interested in hearing from people that are kind of looking at similar opportunities.
Yeah, it seems like in the last, let's say, 5 to 10 years, there's been a labor arbitrage where you can buy a business with US based employees. Let's say they have 1,000 customer service agents in Utah, and each person makes, $65,000 a year. And people would buy that company and they would ship all of those jobs to the Philippines where you can pay people, $15,000 a year, and you're getting a $40,000 savings on the W-2 salary by shipping those by just offshoring those jobs. And now there's this AI arbitrage where you may have needed a dozen people for a specific role or for a specific task, and now maybe you just need one person overseeing the and leveraging AI in that role. So it's kind of interesting to see that transition go from labor arbitrage to AI to labor arbitrage.
Yeah, 100%. And I guess the other thing to think about is if you're not looking at using AI as a lever, as a labor arbitrage, then how does your roll up look like relative to others that are doing that, right? Um, and just from a number of perspectives, one is, or the most obvious one is the financial
Hmm.
side. So what is the financial profile of a AI enabled roll up play versus a non AI enabled, but also scalability and attractiveness for talent and capital and so on. Yeah, so even if you're not considering using AI, I would still like explore what that looks like in the market that you're curious about.
I'm really interested in this application for law firms, actually. In the
Hmm.
last, I think, 4 or 5 years, there's been a number of states that have legalized. So historically, to own a law firm, you had to be a lawyer. In the last 5 years, I think Utah, Arizona, maybe a couple other states have legalized, have passed laws that say you don't have to be a lawyer to own a law firm. So I think to me, it's always felt like I get a build for a lot of hours where there's people just doing legwork, right? They're taking old templates, they're reformatting them into my specific needs, and I'm getting charged for like 50 hours, right? This isn't even the strategy element. This is just the legwork of transforming the documents into a format that's usable by me. And then sure, there's the senior partner that kind of opines on it, make sure the strategy is right. We get charged extra for that, and then we get our documents. Now I think it's really interesting to consider a world where you have a law firm, you can process most of that information through AI. You can take a template, you can insert the bullet points, what you'd like to see on the other side. It'll merge those two things and get the outcome that you want. One concern that I have is just that the billing model in legal isn't designed for the use of AI, right? It's all hourly. So
Yeah.
if you rip out the 50 hours or so that we got charged in order to modify those documents and you did that in two, all of a sudden it's breaking the legal model. So it's good for the customer, it's really bad for the company, and I'm curious what will shake out in those situations.
Yeah, it's a really interesting question. And this is exactly the reason why a lot of law firms have not adopted AI, or sort of like anti AI. Um, my guess is that it may require just a new business model, finding ways to align with how customers perceive value. Historically, and this is just also driven by regulation, but historically, value was perceived as time spent, right? By a lawyer and the knowledge that they have. But if that knowledge all of a sudden becomes heavily commoditized and you can get something in 10 minutes versus 10 hours, it just puts it in check. So I guess a similar one is in software development. So we haven't talked about Thirdera, but another roll up that I was involved in was in aggregating ServiceNow systems integrators. And, now there's a lot of AI co-pilots and agents that enable developers to be more efficient with their work. So if you're charging customers on an hourly basis, or you're telling them something's going to take 50 hours to get done, but now you can do it in 5, um, presumably your revenue is going down by the same factor. So I think there's a lot of services businesses that would need to rethink how they're operating. But to me, that's very exciting. I mean, that's like the opportunity that an AI first company or roll up could bring to the table. And as a result, become a dominant player very quickly, right? If you bring something to market that is just like much better for the customer, much cheaper, that's your edge.
Can you explain for listeners what does ServiceNow do? Because every time I hear the name, I have to look it up and figure out what it does. I always forget, and I only have a loose sense of what it does. And then tell us a little bit about what was Thirdera and what was it doing for ServiceNow clients.
Yeah, for sure. So ServiceNow is a software company that serves primarily enterprises. Today is used by the vast majority of the global 2000 companies, which means just very large companies. And it started off as a IT service management tool. So essentially, if you're a big company, you have a lot of employees using computers, and they have issues with their computers, then they need a ticketing system to submit those issues and have somebody look at them. I mean, this is like a very base uh, basic use case. There's more complex things like managing servers, managing other IT assets, and so on. So it started focused in that specific area. But the way you could create workflows within ServiceNow and configure them was very unique. And it was also at this time where a lot of software platforms were the old on-prem platforms were being disrupted by cloud-based platforms. So ServiceNow was kind of like the first cloud-based ITSM platform. And because the way of creating workflows was so easy and good, um, then it started to expand into other type of workflows outside of IT, like HR, financial management, and so on. So today, ServiceNow is like the enterprise workflow platform. So any type of workflow that you want to create for your enterprise, you can do on top of ServiceNow. Um, and Usually it requires some pretty heavy implementation in order to get it working for your company. You got to, most companies have different type of workflows, even though they call them the same. They're very unique. They integrate with different systems. So you got to have a services company come in and say, okay, let me understand what your requirements are. Let me implement them, integrate them, and so on. And that's what a systems integrator does. So with Thirdera, the way it worked out was I had started a company that was providing services to ServiceNow customers, primarily around managing the platform at run state. So after it had been implemented, these companies required engineers and support to keep configuring workflows and administering the ones that were already configured. So we started this company. We were tech enabled in a way because we were using some tools to make our process more efficient that we had developed, and we also had a pretty large engineering team that supported these customers. So we combined the name of that company was Novoscale. We combined that company with two other systems integrators and formed Thirdera, which eventually became the largest independent ServiceNow system integrator. And we sold that company to Cognizant in 2023.
Got it. And I looked at ServiceNow. ServiceNow is a big company. It's like 200 billion of market cap, 9 billion of revenue or so. It looks like it's a it's massive, and it seems like it's growing too. Um,
Yep.
there's a number of these types of, like, my understanding of the service integrator, and correct me if I'm wrong, is you have a platform like Salesforce or HubSpot, and then there are service providers that are built on top of those, and they make kind of the technology functional and usable for its customers. Is that a fair comparison? Okay.
Yeah. I think that's a pretty good comparison.
Okay. Yeah, it seems like there's a lot of opportunity out there. I see these like Salesforce consultants getting sold all the time. There's like Microsoft consultants. There's every form of like consultants, and these like big businesses or big industries, like multi-billion-dollar industries that are built on the back of these like behemoths like ServiceNow or Microsoft or Azure or AWS or whatever it is. And I think I'm sure there's somebody out there who's thinking about the AI application of, you roll up a number of these, can you kind of lower your labor requirements and increase your efficiency using AI? I think that's really, really interesting. Um, well, good. Esteban, this has been so fun. I appreciate you walking me through the deals that you've done and how you're thinking about the world. I really I like your style. I like your flow. So thanks for taking time to chat.
I really enjoyed it. Thank you so much for having me.